The second execution pattern is a cluster. This is, once again, your supply and demand zones, your order blocks, your failure to returns, and so on and so forth. The cluster, in a vast majority of cases, is a continuation trades. They are found at the levels where large buying and selling happened and where market went from efficient to inefficient. You can see it here on this example. You had this sort of consolidation, market sold off sharply from there. Once we revisit the level, we continued with a selling. The origin of those moves bring new high interest due to stacked orders from large players and traders covering their positions. This is, I talked about this. Those people that were selling the size into this kind of move, they might have unfilled orders here. So if market will come again, they will load out the rest of their positions. People who were buying here, they make this kind of a round trip, and a lot of times they decided to cover their trades, which will also create the selling momentum. Nuances of a cluster, the move should be a strong one that will break a structure. This goes back to the basics of a market structure, basically, where you have this kind of a I know that we cannot see to the left, but let's say that this is the swing low, this which produced the high, and we broke the market structure here. This is your signal that this inefficiency, this large liquidity gap was actually strong enough, and market is more likely to continue. Higher time frame clusters are more significant. This is obvious, as with any sort of levels. Higher time frame levels bring out the more people to trading, so they will pose higher significance. As market consolidate before the moves, you will often find naked points of control at the levels. This is the obvious thing. If this is your cluster, market will move from there. You will have this value area from the day and the point of control there. So you will see the naked points of control at the levels of where the cluster is. This is actually cool because it will easily help you to spot them. If you have something like this, for example, that you have, let's say, the resistance here, market goes down from there, and then kind of builds up the one cluster, then the second one, and breaks the level, and you will have a kind of a high executed volume here. Let's say this happened during one day, so we have this kind of a double distribution day, but the volume executed here is much higher, and you have your naked point of control resting here. Once market is coming back, and you can see, for example, there is sort of a compression here. You can bet that people who will trade this as a simple SR flip might get squeezed, and you will do something like this instead. So the naked points of control are kind of a great for a visual maps, and you can be a little bit clever than people who will just simply buying the SR flip when there is a high executed volumes below you. As I mentioned, be aware of structure that is below you. You want to see a failed swing rather than compression. So you have two types of clusters. One is looking something like this, and the second one is looking something like this. Sorry, this is not the best. This is not what I wanted to show. So let me have another try. One is looking like this, and the second one is looking like this. Okay, so which one is better for trading? It's going to be this one, because before the move happened, you had this sort of a little QM at the level where market, flushed below any kind of a local low there and made a move higher. When in this one, you have this sort of a channel to the upside. So everyone who was building their longs already, they are intact by the move. So what market is usually going to do is going to flush through them and move higher. This is where you need to pay attention to, because you will see that the volume points of control, they don't care about these things. They will be just at the level same as it will be somewhere around here. So you might see the naked point of control go blindly a bit, but you won't pay attention to what is basically below you. Okay, this is a scenario in gold. I showed you this before already, but this is the kind of example of a perfect level where you have these candles, these red and purple candles, which are signals of high relative selling into the level. You have a point of control for this candle at the bottom, so this is the cleanest kind of a flushing of a local level of support before this move higher on a high relative volume. And you can see market perfectly hits the last kind of a high volume last down candle before the move, hits the point of control and makes a little bit of mess, but then essentially moves up. This is also gold, but this is the second example that I talked to you about. You have a double distribution day. For this case, the POC is actually higher than lower, but still, you have a compression here, so this is a good level to buy for the failed swing. Only if that happens, not going, not going in blind, because if you will just buy here, this will work for a bit actually, which is funny, but then it's revisit the level, take out the lows, and you will have a failed swing here basically. So your cluster is here. This is where the high volume came into the market. After this double distribution, you have obviously this LBN, so you might want to expect reaction here. You have this kind of a classic action of high relative volumes to the downside, which is then picked up by a high relative volume on the buy side. This is perfect, and all these kind of a simple exemplification of the supply and demand will point out these kind of candles, and you should be going blindly to them. But if you take a look below you have once again these kind of a higher lows that were not traded before, basically from this level. So as you can see, market will come down on a massive selling, and it will take out this low before making any sort of reversal. So this is the scenario where a lot of people will see this. They will place their limit orders here, below these lows, basically. They put their stop here, and market will just stop them out before reversing. This is once again, this is 4-hour chart on, I believe this is ETH. This is your good structure. You have a level of support that gets taken out. Then you have this kind of a price pause, and market will quickly move higher. But the structure here is basically, kind of a finished structure. There is no reason to revisit these lows because this kind of thing happened. If you would then obviously draw a volume profile here, which I didn't, you would have a kind of a naked point of control somewhere here, which this, on a strong momentum like this, you can see that we barely just scratched the top of this last down bar before we moved higher. Then you get one more actually revisit. As you can see, you will get a revisit into this one. Once again, this is a good structure because you took out the local support before it. It sucks because obviously if you miss buying this one, you want to get into the trade, and a lot of people will then basically say that they will only go long if we gonna basically take this low, so expect a failed swing at this level. But if you look to the left, market pushed up, made a little bit of support, which led people to buy into it, flushed them below, and then reclaim. So in my eyes, I don't really see a reasons to revisit this low. I just want to see kind of a strength coming into that, which happens later on. This is also the example. This is the same chart that I showed you before, and this is a 30-minute chart. This is H4, and this is a 30-minute. You can see how you can use these higher time frame clusters, but then narrow it to the lower time frames. So once again, this looks a little bit tricky because you have this structure here, but you make this little bit of a failed swing before the move up. This is, in my eyes, quite a aggressive trade. With a pretty tight stop only below here, but it's you can see the risk reward of that would be huge. And if you remember from a composite market profiles, this was that 5-day composite value, and you had this value area high here, so you are bringing another level of the confluence to the table, which is, you know, really gives you kind of the confidence to take a trade. And you have also this higher pickup on volume to the downside into the buying. So, but the main point of this is that if I see something like this, obviously you can say that there was a cluster here which we traded and then kind of finished this structure on this local low where we took out this low and move higher. So buying here is actually perfectly fine. And although sometimes it can go lower, if you will be taking trades like this, you know, with your stop only here, even to those highs, this would be around 5-to-1 risk to reward ratio. So, you know, few stops are nothing if you then can catch trades like this, basically. This is the second one. You can see that, you know, without a doubt, you had a inefficient selling on a high volume from the structure. So a lot of people would mark this out as a cluster, but they are missing the point of, first of all, this, you know, this is, I wouldn't short into this, you know, in any kind of case. You know, there are, although this high was kind of taken, we then make a double, even a triple top here, so there is no excess. Basically, you want to see these tops and bottoms made on this, they should look like this, basically. You know, if you have these extremely flat levels of resistance, markets are more likely to revisit them. This is the first kind of a warning sign, and the second warning sign is basically that you are just following this H4 structure of a move. So shorting this is not kind of a best way to do things, in my opinion. Okay, trading the cluster, the limit order is the way to do it. Obviously you can wait for the initial reaction. My issue with that would be that you are basically, if for example you are going to be trading this and you are not sure, so you will wait for this candle to close basically here. But from the risk to reward perspective, you will, you know, this is your initial risk. If you put the limit order there, this is your risk if you wait for a candle close. It's almost doubled, basically, because your invalidation is not below the low. Your invalidation is, you know, ideally below this low, but sometimes the market will revisit the zone more before the moving higher. So if you will, you know, try to always use this kind of a patient approach, you will often find that these levels will get tested, and then you will be like, I will wait for a candle close, but the candle will close somewhere around here. And what you are going to do then, you know, your risk to reward then is pretty huge. So it will lose. It's not gonna make sense anymore to basically take a trade. So the limit orders in this case is the best approach. Your stop loss is below the low, or high of the entry bar. Sorry, this is not. There is a mistake here. It's not the entry bar. Is that a cluster bar? Is a below the high or low of the whole structure. You know, basically for something like this, you would use this kind of a last down bar, or I use the bars with a high volume, basically. So the move down on a high volume. So for this case, I would place a limit here, and my stop would be probably all the way down there. If you are, you know, feeling a little more aggressive, you will be placing your limit at the naked point of control, and this is really a last 30-minute candle which caused this kind of a stop run. This actually makes sense. It's obviously the hindsight example, but you know, getting in here is also kind of fine. My stop loss is below the low of this candle. For this case, you know, you are playing this as a failed swing, so this is a different trade basically, and in this case, you know, your stop loss only marked out this down candle, but I would place a stop loss most likely here, because this is really a level where you don't want to see market trade again. But yeah, so this is the entry bar. Entry bar is basically the last down candle, ideally on a higher volumes, which caused kind of this move up. If there is a compression, flat top, flat bottom around, it's worth to assume it gets traded. This is, you know, something that I mentioned here, for example. This is not always the case, but you will avoid, you know, getting stopped out and then see market going your direction, which always kind of sucks. So you want to observe these things and how markets is behaving around them. The next, the take profit is the next level of potential reversal on the time frame the trade is executed. This is the same for a failed swing. Where would you? Let's kind of think for a second. What is the time frame on this 30-minute chart? What is your next level you want to be taking a profits at when you are taking this trade right here? It's not a 30-minute level, it's a 4-hour level, because you are taking a trade based on this 4-hour structure. Okay, this is something, obviously if you choose a 30-minute level, which is, you know, these highs right here, it's okay because, you know, trade will work out, but you are kind of robbing yourself from a little bit of profits basically, because the next level here on a H4 would be at least this high right here, even kind of this price post, but I think this is actually the same level because it tested it here. Jesus, this drawing tool is, yeah, I would target this high right here instead of these highs. It's, you know, it might seem like a small difference, but, you know, it will actually make a quite a bit of amount of difference where when, you know, you will start trading with higher amounts of money. So always know on what time frame you are executing your trade, where the structure is coming from, and then pick a trade on pick a target on that time frame as well, you know, and you will be just kind of a trailing stop losses based on the market structure. So for this example, you are getting along here. Once you kind of see this initial move after this failed swing on a 30-minute, I would move my stop below this low. Then you will have this little bit of a V-shaped reversal and retest of this really tiny cluster here. Once again, if you take a look, you have this intraday double bottom, market trades it, so there is no amount of compression left here. This is a nicely made bottom, so you are gonna move your stop loss here. Then market will pause at the top before this high, and you know, I wouldn't move stop loss at this point much. You need to watch your evolving R. So for example, this we will talk about it in a bit. So it doesn't really make much sense to, if your target is here and your stop loss is still here, and you will see these kind of rejections from the top, I would probably close the trade after this candle basically, because then you're risking market will go all the way down here only to capture this last kind of leg up. So closing here is fine, but if you decide to stick to it, once again you will have this little bit of a run below this low. So you can see the point of control is below them, so then you can just place your stop basically below these lows, and then market will just kind of finish the move. So yeah, this is how you trail your stops. You know, this trade on gold is quite a tricky one. This is actually the trade that I took, so I can talk about it for a second. I also posted it on Twitter, so you can find it there, but I took this long and my execution was really good on this one. Market immediately went from my trade, you know. My stop was basically below this low, then I, you know, moved it below this low, but we moved higher and we came into the NFP on Friday, and this trade first and foremost was done based on the H4 cluster, which is also kind of a QM structure and based on a daily failed swing. We hit the daily level of support and we rejected it. So I am playing a kind of a daily bias overall. So I want to see this market to go a little bit, but it's complicated because I get in a trade here. It's awesome, it's not going against me. My stop is at this point really tight, so I'm not even risking full 1 hour. But then what is about to happen? This is on Thursday and market starts to make this compression to the upside, coming into the non-farm payroll basically. So what am I supposed to do at this point? I need to be fine with the fact that this can get taken and retrace, and in this case it retraced quite a bit. When it's sort of this much like this, I was actually expecting that I will get taken out because obviously the liquidity was extremely low, so it can just wick below my entry, but as you can see, market didn't take me out and then continued higher, but once again on this massive amount of compression. So what I did then yesterday, because my target was basically filling this all the way up here, even I wanted to take it I wanted to take most of here because this is where this structure got broken, but I was also thinking it can run all the way up here. But after this compression happened yesterday and we were coming into the daily close with this little bit of rejection, I just closed the trade out because it wasn't for me to see something like this happen. This is not thing that I want to hold through on this amount of compression. There was actually a kind of a perfect way how to solve this trade, or how to play this trade, which was which is just always kind of this thing that is obvious in hindsight, but when market is moving in real time, it's not so simple often. You have a failed swing on a high volume right before the non-farm payroll hits. So what I should have done is close the trade here at full and then re-enter the trade in this kind of a QM level, because you can see there is a level of support that's got taken out. You have a V-shaped reversal. You essentially made a new high here, so this is a valid kind of a V-shaped reversal. Just the structure below it is quite a poor. So yeah, I should have exited the trade and then rebid the level again here. But obviously this is hindsight. I just decided to stick through it because, to be fair, I was just expecting that it will quickly move below this low, put kind of a failed swing and continue higher. But it made much deeper pullback into, and then just kind of struggled it and just drifted higher. So yeah, this is not the optimal trade because the structure is not fine here, but just the example that I wanted to show you basically. So yeah, this is the trade I covered here. For this one, once again, once you get this huge reaction and you break these highs, your stop can go below this low. Then you need to kind of sit through this, because obviously you are just pulling back. You are holding this as sort of a QM again. There is a little bit of a failed swing in here, you can see, so I wouldn't immediately move my stop below this low, but once market once again kind of start to reclaiming this level of prior support, then you can move your stop below here. Then obviously we make a new high, so you're gonna move your stop below here, and then you will just kind of hit your take profit in very short amount of time. So that's that. So yeah, I hope this is the quite self-explanatory, and you see the things that you should be kind of paying attention to and so on. Let's take a look at the QM pattern.